We've all heard the stories of the all or nothing trader that loses all of his money trading stock options. He knows he can make a killing if he just gets this next trade right. He feels like he's at the table in Vegas and going all in. Guys, this is not how you trade stock options. It's not how they work and definitely not the way you want to be trading them. In this video, we discuss a critical factor that you must understand if you're going to grow an options trading account consistently. We answer the question of whether you should buy or sell stock options. We also show you exactly how to do it with a real example that can be used to collect monthly option premiums consistently, month after month, while lowering your risk at the same time.
Hey guys, Darren here. Thanks for joining. We talk about action steps you can take today to increase profits and reduce risk in your options trading portfolio. Please check out and download the free options workshop in the link below.
It talks about the two main reasons why options can be less risky and more profitable than just buying stocks alone. It also details how to profit in both directions and pick your win percentage, which you can't do buying stocks alone. Please hit the like and subscribe buttons below. I'd appreciate it, and it helps get the video out to more people. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research. If you're new or learning options, I recommend you start small. All right, let's review the two types of options, calls and puts. A call option gives the option holder the right but not the obligation to buy shares of a stock at an agreed upon price on or before a particular expiration date. So when you buy a call option, you're betting that the price of the stock will go up. You can sell it at a higher stock price than you bought it and bank the profit because the option price will be higher as well. A put option gives the option holder the right but not the obligation to sell shares of a stock at an agreed upon price on or before the expiration date. So when you buy a put option, you're betting that the price of the stock will go down. When it does, you then buy it back at the lower stock price and keep the profit. So that is how puts and calls work in a simplified explanation. Now let's take a look at selling versus buying options. A common analogy that is often used is to think of options as life insurance. Buying options is like buying insurance and paying premiums month after month. And who do you buy options from? An insurance company, right? So selling options is like being the insurance company. Now, do you think it's more expensive to insure someone in good health or someone who smokes and drinks and may have a pre-existing medical condition? Right. The person in bad condition will cost more in monthly premiums for sure. This person is a high volatility or a high risk person. There's a much better chance that this person will not live as long as someone in good health. Thus, there is a higher probability that the insurance company will have to pay out a large benefit sooner on the high risk person. Just like life insurance with options, you pay monthly premiums to protect against risk and big moves in the market. The higher risk or high volatility options that move more, maybe like a Tesla, will be more expensive than the lower volatility options that don't move as much, maybe like a Coke or a Procter & Gamble. So, would you rather be the insurance company collecting those premiums or the person paying them? The insurance company, of course, right? Options premium is the price of an options contract. It is determined by the underlying asset's price, strike price, time to expiration, and volatility. Option buyers pay option premium because it gives them the right to buy or sell the underlying asset at a certain price. Option sellers collect option premiums because they're selling that right to someone else. Now let's take a look at a real example. We'll sell a put option in PayPal. With the stock trading at $80, we sell the $70 put option and collect $271. If the stock dropped below $70 before the expiration in 44 days, we can be assigned the stock at $70. We keep the $271 in premium if it stays above $70. This would take a fairly large 12% move within 44 days to expiration. If it did happen, we own the stock at a huge discount to where it's trading today at $80. The trade has a 75% probability of profit, which is pretty good. Now, what if we took the other side and bought the option? If we buy that same put option, we pay $276. By paying that premium, we then can own the stock at $70, the strike price, if the stock drops below that price. This can serve as protection or insurance against a big down move. However, notice it has a very low probability of profit of 24%. So do you want to sell options with a high pop or probability of profit of 75% or buy options with a low probability of profit of only 24%? Would you rather be the life insurance company collecting monthly premiums or the individual paying the monthly premiums? Would you rather be the casino collecting the 5 to 10% rake and house advantage or the gambler making bet after bet and hoping to beat the house with the next big bet? It's pretty obvious that the house always wins, right? Insurance companies tend to do pretty well too. They are some of the most solid and profitable companies in the world. So it's a no-brainer. This is why you want to sell options and be like the insurance companies and casinos as opposed to those paying the monthly premiums or the gambler looking for the next big win.
All right, guys, I put a link down below for the free options workshop. Be sure and grab that. Also, let me know what you thought of this trade and what you're trading in your options trading account. Thanks for watching and see you in the next one.